Hey, good morning, everyone.
Good morning, Professor Hung.
Good
Hey,
morning,
good
Professor
morning.
Hong.
Hey, good morning, Ebony. How's
Hello.
everybody? Hi. Did you guys have a good spring break?
Too short.
Yeah. It's short, I didn't even have any spring break, I'm on a departmental personnel and budget committee, and during the spring break, we had to interview a lot of applicants for 3 electoral positions. So I didn't have any spring break. Um, so spring break is not really a vacation. It's a let up. It's just 1 week release of 1 week, so that you can catch up. You can catch up with whatever you're behind with. So I hope you have all used spring break for that purpose. So let me, okay. Well, I'm not very good at multitasking. So while I was speaking, I wasn't sure what I was doing. I needed to share the screen, and okay, so my screen is being shared. So I have 9 people currently here. Let me take a look at look into the today's forum and check how many people are there. Oh, so there are, okay, 10 people. So that's just about the same number of people here in the Collaborate session. We're just still waiting for the others to join us. So before the spring break, right, in our last class, which was on April 9th, um, we were somewhere here, right? We were discussing basically, um, how we define return, and of course, we know return is defined as see. Return is defined as PT minus PT minus 1 over PT minus 1, right? Everybody should understand what these symbols represent, right? Of course, PT is price at time t. PT minus 1 is price at time t minus 1, okay? And price at time t minus 1 could, t and t minus 1 can be this year and last year, right? Price at the end of this year, price at the end of the last year, or price at the end of this month, or the price at the end of the last month, right? So basically, what this formula is showing you is basically, I think I better not. Where's my pen? Okay. This is what they call capital gain, right? Think about it. If the stock you bought last year was, $100 at the time, and the stock price today is 120, right? Then the difference is called capital gains. Okay. And if the stock has paid dividend during the year, right? And of course, it will be at the end of the year, right? There should be some of all the dividends, some of all the cash flows, right? In general. But we are assuming that this is zero, just for the simplicity, for the sake of simplicity. We'll just assume that this is zero. Okay, we'll just assume it away. then everything is nicely, defined as pt minus 1 over pt minus 1. That's the return. But then again, you can break this too, right? So this term can be broken into pt over pt minus 1, right? And then minus pt minus 1 over pt minus 1. And pt minus 1 over pt minus 1 is 1. So if I rearrange this, I mean, if I add 1 to both sides, right? Then the left-hand side will be 1 plus RT, and the right-hand side will be only PT over PT minus 1. Now think about it. What is this? I mean, what's the difference between these two? If you think about it, this is the gross return, and this is the net return. Why did I write it? This is the net return. Isn't that right? In our example, if the price last year was $100 and this year $120, the net return is 20%. The gross return is 120%. Right? Does that make sense? Everyone, are you there? Is anyone there?
Yes, Professor.
Yes, Professor.
Yes, Professor.
Okay. Yeah. So that makes sense, right? You guys are just almost, very dead quiet, dead quiet. So I wasn't sure if anybody was listening, or even if you were listening, I wasn't sure if you could understand that. But that's not a very difficult concept, right? The difference between the gross return and net return, right? Now, so we will be, so basically, so in our last class, we were talking about, APR versus EAR. So APR is basically, for example, APR is the given return, right? Stated return. Of course, in case of stock, there is no stated return. No stock can tell you the return will be this, right? Because the stock's return will depend on actual return, right? But if this is a bond, right, or a bank interest rate, there is stated interest rate, right? If you put like $10,000 in the bank, they will tell you. I mean, if you put $10,000 into CD, right, they will tell you the CD rate is, just to make it simple, 10%. I mean, realistically, there is no such thing as 10% interest rate these days, but at best it would be like 1.5% at best CD rate. So, but if we assume 10%, right? Let's think about it. And if the compounding is, so they put okay, 6%. Excuse me. All right, I had to clear my throat, and I'll have to Ricola. I need, things like Ricola for my throat. So this file, you can find this. So let me first tell you where you can. I want you to download that file because if you go to our topics folder, right, as you scroll down, there will be something like, risk and return finance 100 review, risk and return, risk versus return finance 100 basics Excel file, right? This is the one, right? Download it. Click it and download it. And when you download it, you won't be on this page, or you won't be on this worksheet. It will be on, pretty much like this here. But look for this bottom tab. Okay, look for this bottom tab. And when you have just opened it, and if you did 100 with me, this is something you have seen already in 100. And you will see that after column D, you don't see the other E, F, G, H, and you will see just right away column I, because I collapsed those columns between D and I collapsed. Later you will see. Now let's think about it. So you suppose this is $10,000, just to make it more realistic. Okay, 10,000. Because if you put money in the CDs, oops, what? Okay, all right. If you put money in the CD, one CD contract is 10,000. So and if the interest rate is 10%, that's the stated interest rate. Okay. But depending on the compounding frequency, the future value will be different. So do this. If you bring your cursor to the borderline between the column headings, right? Between the borderline between the column headings, and double click, it will expand the columns. It will expand the columns. So you all understand that the future value will be different, right? Depending on the compounding frequency per year. Now, this is something you already learned, in Finance 100, and I also was going over this in our last class, right? I was going over this. This N here is actually compounding frequency per year. So this is actually M, right? In my notation, it is M. What would M stand for? It will stand for how many times, right, does the compounding take place per year during a year, right? That's what that M stands for, right? Multiple times. So if it is 1, there's no difference. I mean, the periodic rate, there's no difference. It's going to be still, because compounding is only once. And 5 years, it will still be 5 years, because N is T times M, meaning, so are you all doing this with me?
Yes.
Everyone, okay. Yeah, well, please do this with me, because it's all to your best interest. It's all to your benefit. I mean, if you don't do this with me later, if you want to do it alone, of course, the recording of this session will be posted there. You can retrace it, but why waste this time, right? It's always the best alive, right? Or live in this case. It's always best live, doing it live. Okay, so now think about it. But then, if the compounding frequency is twice a year, right? Semi-annual, quarterly, monthly, weekly, daily, right? If there are 1,000 compoundings per month, 10,000 compoundings. Now the periodic rates will be all n total number of compounding n, right? Will all will change, right? Increase decimals, okay. More. Okay, you barely see 0.0001 here. Now, we understand, the more compounding, right? The more compounding. In other words, the higher the n, higher the frequency of compounding, the greater the future value. We all know it's going to be 1 plus r is to n, and then you drag it down, right? Which is not a difficult thing, but you see the future value is greater, right? The higher the compounding frequency. Now, APY or EAR, equivalent annual rate, is basically what kind of APR will take you there. I mean, without this many compoundings, right? In other words, with just a single compounding a year, what kind of interest rate, what kind of APR will take you to the same future value? That's what APY is, annual percentage yield or equivalent annual rate is. That's what it is. You understand? What kind of simple interest rate, what kind of annual simple rate, right? When compounded just once a year, will take you to the same future value, like this. Okay? In other words, think about it. When compounded just once, if 6% is compounded just once a year, you cannot get to this. If 6% is compounded just once a year for 5 years, it will only be this, right? So the question is, what kind of APR, right? What kind of interest rate, simple interest rate, will take you to the same future value without getting compounded daily for 5 years? In other words, just compounded once a year for 5 years, right? The rate that can take you to the same future value like this, that's the APY. And how do you find it? Well, the formula is basically and I already that is already explained here. 1 plus APR over M. This is actually M, right? In my notation, this is actually M in my notation. M. Okay, that's actually my notation. But the book is using N, right? The book is calling it N, but N is the actual number of compounding. think about it. If the compounding frequency is quarterly, if the compounding is quarterly, right? Over 5 years, how many compoundings actually happen? Over 5 years, there will be 20 compoundings. That's n. N is, the total number of compounding. So then, how many compoundings per year? That's n. And that's my notation. Although this book uses n for that, just to avoid any confusion, just, unified as m, okay? So this is what APY is. So then what do you need to do? Oops. All you need to do is 1 plus APR over m raised to m. Of course, in what's happening? Oh, what did I do? 1 plus APR over m raised to m. And of course, when m is 1, it's annual, right? Minus 1, and then minus 1, I'm sorry. Forgot about minus 1. But we're talking about the net return. If m is 1, there's no difference. But as the m goes up, you will see that simple interest rate will have to, go up as well. And you might say, oh, it's going to be all the same after, after 10,000. Actually, you will see the difference if I increase the, let me increase the, increase the decimal, and you see the difference, right? You see the difference there? So this is APY or EAR, okay? So I don't know if you ever bought CDs from the bank, but if you buy CD, they will tell you, APR 6%, APY 6 point something. There would be the difference between APY and APR because the compounding frequency is not annual. If the CD's compounding frequency is annual, then there will be no difference. But at least they will give you like semi-annual or quarterly compounding, at least, right? So there will be no difference. Then so then our next question was, and you can, if you solve it in reverse, right? In other words, previously, EAR, APY was the thing in the question, the unknown. But if APR is the unknown, if you know the EAR or APY, but APR is the unknown, you only need to solve it backwards, in reverse. Then you can get to APR. Okay? Now, next question is, continuous, we were talking about continuous compounding, and continuous compounding means, literally, if we expand the compounding frequency, in other words, m, if we extend m to infinity, right? What's it gonna be? If we extend it to infinity, and think about it. Why do we extend it to infinity? Because if m goes to infinity, we are basically trying to split time into very small fragments so that we can capture or we can emulate the smooth fluidity of time. Because think about it, time is continuous. Time is not a discrete thing. We just define time by discrete units like year, month, quarters, weeks, days, hours, minutes, seconds, But think about it. That's basically human invention, or not invention, but it's a human measure. That's the way the humans measure time. But the time itself never declared, time per se never declared itself in those discrete units. Time is continuous, like flowing water. And think about it. The reason for as I said, the reason for splitting time into very, very small, minute fragments is to emulate that smooth fluidity, the continuity of time. Why? Because if we have, let's say we have, daily stock prices. I mean, even if we have daily stock prices or monthly stock prices, and with monthly stock prices, what will you see? If you will be plotting, right? Let's say if you have, of course, this is time, and of course, this is dollar price. And if it is monthly, right? 1, 2, 3, 4. I mean, annually, there will be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, right? I mean, if you have this data, let's say the stock price was moved like this monthly, right? Think about it. If you connect those dots, right, there will be a lot of kink, right? A lot of kinks, right? But if we have quarterly stock price, there will be more kinks, right? Quarterly, because quarterly stock price, 1, 2, 3. So from here to here, and then 4, 5, 6, 7, 8, 9. This will be 12. I mean, if we use quarterly, the more it will look more kinked or more rough, right? Suppose we used, quarterly price, then you will see something like this, and then June, you will see something like this of September. You will see something like this. You understand what I'm trying to get to? And if you use daily, it will be smoother. At least, you might think quarterly will be smoother. No, what I'm saying is it will. The quarterly is too. Quarterly is already, so quarterly is already so different from the reality, right? I mean, monthly price movement is already different from like, minute by minute or second by second, the movement of the stock price second by second, right? Monthly would be daily. I mean, so if we, let's say, if we have daily price, let me try. Okay, if we have daily price, it would look more like this. But it will be it will reflect more the reality. And so if daily price is like that, what would the hourly price would look like? What will the hourly price look like? Hourly price will look like more I mean, it will be more closer to reality. And if we do this, if we extend it hourly by the minute or by the minute, by the second, it will look quite. It will really represent more, reality. And so, if we extend our M, right? If we extend M, if we extend it more, right? I better not use red. Oops. So I don't know, maybe this. Okay, so if we extend M to infinity, it will really track the real shape of the price movement, right? So in other words, we can capture that smooth fluidity of the price movement as time flows continuously, right? If we extend, so that's the idea, right? Everyone is okay with that. Everyone is fine with what continuous compounding is. Mm-hmm. So you're dead quiet. How many people understands this? Are you guys there? Yeah, Dimitri, you,
Yeah, I'm
you
here,
have
Professor. Yes, Professor.
so you guys follow, right? You guys are
Yes,
following. You
yes.
understand, what I'm talking about. Okay.
Like almost like maybe 90%.
Yeah. I mean, you may not, get 100%, but basically, if you're, setting your foot on the right path, that's what matters. So think about it. All of these, oh, I'm still, what did I do? So as the compounding frequency increases beyond, 1,000, 10,000, 1 million, look, the APY reaches, some limit. It doesn't increase like, it doesn't increase like, it doesn't increase like 100% or 200%. No, it increases by obviously the more high the compounding frequency, the greater the future value, or the greater the effective interest rate. This is also called effective interest rate, APY or EAR or effective interest rate, right? But there's a limit. And then, so suppose column I is just a thought experiment. So if APR is if APR is 100%, think about it. If that 1 here, 1 in 1 over m, that means instead of APR 6% here, your APR is not 6% but 100%, right? So that means if your money doubles in a year, right? What if our compounding frequency increases like this, right? Will our money not only double but triple or quadruple? No, actually, it won't. And it's not a difficult thing to understand. Right? Read it to M, and let's drag it down. Of course, when APR is 100%, 1 year later, you will have you will double your money. 1 year later, you will have double your money. But if compounding is twice a year, semi-annual, quarterly, and annual, monthly, annually, see how it goes. Does it triple, quadruple, and quintuple? No. There's a limit to what it can, within 1 year, there's a limit to what it can do. I mean, it's gonna increase. It's gonna increase. But as the compounding frequency goes up, it will certainly increase, but it reaches a certain limit beyond 2.718 something something, right? So this is the gross return, right? This is the gross return, not the net return. But to get net return, you'll have to subtract 1 from it. So you see what I did here. This is the same thing, but I subtracted 1. If I didn't subtract 1, it's not going to be just 6%, but it's going to be 106% and something, right? If I subtract 1 from this, it's going to be 1, 1.25, 1.44, 1.61, right? If I subtract 1, but so this is gross return, right? You have to understand that this is gross return, right? This is gross return. So what do you see here? That when the compounding frequency increases, it reaches a certain limit. It doesn't go beyond 2.71828 something something. But what is then? This is when compounding frequency is like 100 million, right? This is 100 million. Compounding frequency, 100 million compoundings per year. But if it is infinity, in other words, infinite compounding per year, what if the compounding frequency is infinity? Then we have to then at that ultimate end, right? That's what we get when we that's the Euler's number or exponential function, right? So in other words, when m goes to infinity, right? We talked about this in the last class. This number, think about it. When we're assuming that APR is 100%, right? If APR is, because if it is 1 later, we can switch it with any APR. If APR is 1 or 100%, right? But compounding is infinite per given year, right? What's this number going to be? In other words, I talked about this. This number, this is not going to be 0, right? 1 divided by infinity, it will take you to a very, very small number, close to 0, but it's not exactly 0. So if it is 0, there's nothing to worry about. If this thing is 0, the whole thing in the parenthesis is just 1, and 1 raised to infinity will just be infinity, right? But this is a number that's just slightly greater than 1 because it's 1.000000000, infinitely 0, infinitely 0, infinitely 0, and 1. And you raise it to infinity, what's it going to be? That's what this table is about. So try this. I mean, if you raise it to, again, why did I? Okay, so that ink is, so if you raise it to infinity, so what you need to do here is actually, you raise it to exp. exp is, basically Euler's number. You're raising it to 1 year times the interest rate. So R times T. So this is, 6% times 1 year. So we don't even have to, minus 1. Okay. No, it's just 1, right? Because APR is 1 in this example, right? In column I, APR is 1. And we're talking about the gross, right? Not net, right? Gross, gross return. So what do you see here? This is basically, when you raise, this is basically, okay. This result is called Euler's number, right? Which is 2.718 something something. And, this is it, right? When given rate is 100%, right? When given rate is 100%, okay, or 1, right? 1. Now then, think about it. If what's going to be the future value if we continuously compound, in other words, when n is infinity, then we are compounding frequency is infinity. If the compounding frequency is infinity, you are infinitely compounding it, right, per year. So for 5 years, what's going to be the future value of that? What's going to be the result, right? The future value, the result of that continuous compounding. Well, then all you need to do is principal times e raised to r times t. So I said exp is the Excel's command for the Euler's number or exponential function. So it's e raised to r times t, right? It's like e raised to r, right? 6%. And for 5 years. Okay? There you go. That's the future value when continuously compounded. And it's actually less than compounding when compounding frequency is 100 million times a year. This is 10 million, I believe. 10 million, it's close to when it is 10 million. But actually, if we get the APY, if you find the APY, so APY is, you see, what is APY? It's basically, 1 plus APR over m raised to n, and then minus 1 because we need the net rate. We want the net rate. But in case of continuous compounding, it's going to be exponential function exp e raised to r minus 1. And you don't have to multiply it by 5 because we are not talking about 5 years. We are talking about, because we are talking, rates are always annual, right? Per year, right? We're talking about the return per year, right? So e raised to r times 1, right? And we don't need to times 1. We don't need to do the times 1 because it's not going to make any difference, right? Then what do you see? 6.184%. And if I increase the decimal places, it's pretty close to, see, 10 million compounding per year is pretty close to infinity. 10 million compounding is pretty close to infinity. Actually, 100 million compoundings per year, that's actually greater than compounding by infinity. But so for all, but this captures, in other words, Euler's number captures basically continuous time. It captures continuous time, therefore continuous compounding. Okay, so everyone got the same result? Okay, I can't see. What was that? Okay, Robert. The sad thing is that you missed all of this, but of course, you will have to make it up by watching, the recording of today's session later. Okay. But did you guys all get the same result? There are 10 people here, 10 people in the collaborative session, and nobody's responding. Yeah. Anyone there? Is anyone there? So dead quiet.
Yes, sir.
All right, Alpha. Alpha, did you get the same result? Did you get the same result? Actually, this is the repetition of this is the review of Finance 100, and I shouldn't I shouldn't have spent 1 hour of our class time just reviewing what we did in Finance 100, but it's because I had to do it because none of you seem to understand what's going on. None of you seem to understand what's going on. So did you guys all get the same result? I guess nobody got the same result. So what are you doing? I mean, you need, if you are doing this, and if I've been telling you that you need to do this with me during the class time, otherwise, you won't be able to get it. It will take more time if you retrace this by watching the recording of today's video. If you want to retrace this, it will take more time. And if you do it now, if you are stuck, if you don't, if you run into a mental block, or if you're stuck, you can ask me. Okay, that's the whole idea. So now you should understand what Euler's number is and what continuous compounding is, and then and we talked about we talked about log, natural log in the last class. So I cannot recap everything. I cannot recap everything, every time. But you understand that we can take the natural log is the log that uses Euler's number as the base. Okay. So there is log, a common log, which uses 10 as the base, right? You can take log of any number x to base 10, but then the limitation, the problem is that if x is not, let's say if x is some powers of 10, like 100 or some powers of 10, it's easy to visualize what this number will be, right? And also the property of log, also one of the properties of log is here, I want you to, this file is also from Finance 100. This is something that was done in Finance 100. And if you took 100 with me, this was already done. And even if you, the sad thing is, you did Finance 100 with me a couple of semesters ago. Now you don't remember that at all, right? Nothing is retained in your long-term memory. And this file, actually, again, if you go into our topics folder, right? Here's review of Finance 100 basics, right? Please open this and go to, if you go all the way to, I don't know what the page number it is, I don't know, but you can tell towards the end, right? By that scroll bar, you can tell it's almost close to the end. And I'm explaining here properties of log. Now, one of the properties of log is that, log of x times y to base b, right? Log of x times y. Am I? Oh, okay. So there it is. Okay. The ink. How do I? I want to get rid of this ink, but where did it go? That bar for ink. Something's not. Okay. Forget about. I mean, it's not a big. So. Log of x times y can be broken up into a log of x. I'm going to come back to this later because one of the properties of log is that when you have log of x raised to p, right? X raised to p, that p can be, that exponent can be, brought down just like, a coefficient. So you can rewrite, for example, log of 64 to base 2. We know 64 is 2 to the 6th power. And when this base and this number is the same, right? And basically, this exponent, 6, can be brought down so that it can be a multiplicative term. In other words, what used to be a power function is now a multiplicative function or product. And then when the base and this number is the same, that's just 1, right? Because think about it, it's 1. And I've been telling you because, log of 10 to base 10, it's just 10 itself. I cannot, where is that bar? That disappeared, that bar disappeared. Yeah, I need something like this, but that disappeared. Okay, let's see if this works also here. No. Okay. This thing is 1, right? Why is it? Okay. So that property of log can be used nicely, right? So again, the point is, if we use common log, right, with base 10, and if x is some powers of 10, this can be nicely rewritten as n times log of 10 to base 10. And since this is 1, it just, reduces nicely to n, right? But again, we don't know what this x is. I mean, x doesn't necessarily happen to be something, some powers of 10 conveniently, right? So that's why we use, natural log. Natural log uses, Euler's number as the base, right? So, which is, also, which can be also written as ln, natural log, of x. So if you are taking the natural log, um, which is basically, we're gonna, uh, which is for continuous compounding. But before we get to that, let's think about, how we turn a discrete return into a continuous return. Okay, how we turn a discrete return, this discrete time return, to a continuous time return. Okay, so but let me. The time is already. So this is a very theoretical part, but there's no way we can bypass this, because if you don't understand this, the things to come later, you just don't have any, you can't understand what comes next, right? Because it's all about continuous compounding. So uh, the time is already 10:36. So let's take a 10-minute break and come back around 10:45. Okay, and then we'll get more into this. All right, so 10 minutes. Okay, let's take a 10-minute break. All right, we're back. We're back. So now let's think about how we turn discrete time return to continuous time return, right? So basically, discrete time is, this discrete time return is something that we already know. I mean, how do we find return? How do we calculate return? We calculate return this way. We already talked about it previously, right? Return is uh, price at time t minus price at time t minus 1 over price at time t minus 1. Of course, we assume that the cash flow during this time is minimal, insignificant, right? Almost zero. And then the only source of return is capital gains, right? And if that's the case, and this t can be 1 year. I mean, if t is the end of this year, that means t minus 1 is end of last year, right? If t is this month, t minus 1 is end of last month. If t is this end of this quarter, t minus 1 is end of the last quarter. So these are the prices at the end of last quarter, price at the end of this quarter, or the price at the end of this year, price at the end of the last year, and so forth, right? So then this return is annual return or quarterly return or monthly return, right? Depending on what t means. Okay? Is everyone okay with that? Everyone? Anyone? You guys are still dead quiet. Can you hear me?
Yes, Professor, we hear you.
Okay, only one person. Somehow the rest of the class is all dead. So Irina, you follow so far, right?
Yeah, we're trying
Irina?
like to yes to catch up everything.
Yeah.
Just wait, like we're going back and forth to the file and to the video. So sometimes it's hard like to give you the answer right away.
Yeah, I understand because you guys can only see one screen at a time. Yeah, so can I. I mean, I've been meaning to get these, big monitors. I mean, these days I only have one laptop, but most people have like big monitors, two monitors, connected to one laptop. So if you have then you have like three monitors. And if you have like multiple monitors, you can open one window in one monitor, another window in another monitor. So you can see them all simultaneously. But if you have to switch back and forth between one screen and another, I know it's kind of difficult. But anyway, so if t is price at time t is price at the end of this year, and t minus 1, pt minus 1 is price at the end of last year. This return is annual return, right? And if this is if pt is the price at the end of the month, pt minus 1, price at the end of the last month, then this is quarterly return, right? But these are all discrete time returns. Discrete time, right? You understand? Time is discrete. Not time is by itself. Time by itself is continuous, but because humans use measurements like years, months, quarters, days, weeks. That's discrete unit of time. And so we use daily return, monthly return, weekly return, right? Daily return generally we don't deal with but daily return, that's basically a percentage change in price. daily return is basically percentage change in price. Isn't that right? Every day at the end, you see constantly, right? Today there is no, today is Saturday, so there's no market movement. But look, we had a very, very bad week. My portfolio lost more than 10%, from its highest point. But this week was very bad. But normally when there is trading, right? During the day when there is trading, right? Let's say Dow Jones, every minute, every second, you will see. I mean, not every second, but whenever there is, a change in the index, that means there has been a lot of transactions. Whenever there has been a change in the index, that could be by the second or by the minute. You see constantly the price changes expressed not only in the index number, or if it is a specific stock, you see the change not only in price but also in percentage. This is compared to 2 years ago, May 2000. Of course, compared to May 2020, we are about Dow Jones is about 45% higher, and Standard and Poor's is about 50% higher, right? So you see the you will see the percentage change in price, and that's the return. And that's every minute you will see that every minute in Yahoo Finance you will see the percentage change every minute, or every time when the index number changes. Basically, that is all measured, right, by where was I? I was here, right? But basically, we want, if you are not familiar with continuous time, then you will need to simply use, you will need to simply use discrete time. So annual return or monthly return or quarterly return or weekly return or daily return, right? You calculate it this way. But if you use, a continuous time, then the return will have to be expressed by log, right? Natural log. You'll have to express it by natural log. Now, think about it. The natural log, so if you take the natural log, and I told you, you can take, the reason we take the natural log is because, we don't have any limitations to what should be the limitations that comes with the base. I mean, common log, usually the numbers that are powers of the numbers, if you are taking common log, common log is the log with to the base 10. If this x is some powers of 10, it's easy to visualize what the result of the log will be. Okay, it doesn't mean that we cannot take, if it is, we cannot take common log of a number that isn't power of some powers of 10. I mean, we can take it, but then it's really, really difficult to visualize what it is. Okay, but if you take natural log, in other words, taking log of any number to base e, right? Then we can take log of any number, and it's continuous. The number is basically continuous number, right? E is Euler's number is a continuous number, which is based on a very, 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 very small change. So it's the small change, like change of 0.000000000000 infinitely 0 and 1. So it can be the base of a very, 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 very small increment, right? Small change, which is which can be the really which can be the price, which can be the case of the price change over a very, very minute segment of time, right? So, so if you take the natural law, right? So here, let me show you. So if you this file is what? This file is our, this one is this, right? Risk and return, right? I'm sorry, chapter 5 and 6 exercise, right? Chapter 5 and 6 exercises, right? And we were talking about this last time. So here, I reproduced it here. So this is how you define, how you find return in discrete time, but in continuous time, you'll have to take the natural log. So if you take the log of the left-hand side, you have to do the same thing to the right-hand side. So if you take the log of the left-hand side, also you take the log of the right-hand side. Oh, I forgot to put log. So let me. Okay. Log of the right-hand side, and the right-hand side, we'll just call it the thing in the bracket. We'll just call it thing in the bracket because this is the thing in the bracket. So the thing in the bracket will have to be pt minus over pt minus 1 over pt minus 1. But it's actually like pt over pt minus 1 if you take the log. And I'll explain why. I'll explain to you why. Because think about it. PT over PT minus 1 is the gross return, actually, isn't it right? It will only be the case. This is like taking the log of this thing. In other words, this is like, then think about it. I told you this is the net return. Net return is basically gross return minus 1. That's the net return. And if we move this one to the other side, right? If we move this one to the other side, this will be 1 plus RT. And the right-hand side will be just PT over PT minus 1, right? This is a very basic concept, but so many people don't understand the difference between gross return and net return. Gross is always, remember, if the interest rate is 6%, the net return will be 6%, but the gross return will be 106%. Isn't that right? If you put $10,000 in the bank at 6% interest rate, 1 year later, you will have $10,600. right? That's 106%, right? That's the gross return, the total entire total result of that compounding, of that whatever future value is, whatever the return is there between the future value and the present value. But in terms of return, net return is only 6% because 100% was already there. That $10,000 was already there. So that's the difference between the net return and the gross, net and gross. But a lot of people have a hard time understanding the difference between the gross and net. And it's a very sad thing and disaster if you don't understand the difference, right? On finance 300 level, right? If you don't understand it on 100 level, okay, maybe, this person may have very weak math background or, quantitative, this person don't have, enough math foundation. But if you're in a 300 level, there can be no such excuse. Weak math foundation, that shouldn't be an excuse, right? So anyway, so think about it. If we take the log of the gross return, right? Log, in other words, log of 1 plus RT, then the right-hand side will be log of PT over PT minus 1. But that will be the net return, log of net return, which is log of, will be just PT, log of PT over PT minus 1. It will be the same thing as the, gross return. How come? Why? It works only, it is the case for the return that is a very small return, right? Like between 0 and 1, number between 0 and 1. Number between 0 and 1, number between 0 and 1 can even include like 99% return. Isn't that right? 0.99 is still number between 0 and 1. But for those, small changes, small returns, small changes, the gross return and net return when we take the log of that, there's no difference. There's no difference. Okay, and I'll show you why. So for continuous compounding, for the return in continuous time, in continuous compounding or in continuous time, is simply log of PT over PT minus 1. Okay, so let's see why. Let's see. So that's what this exercise is for. Now let's take a look at this. If the price at time t minus 1, last year the price is $100. This year price is $1,000. What does this mean? There has been like 900% growth. Isn't that right? The net return, PT minus 1 over PT minus 1 is 900%. Well, that's not nothing new, right? Okay, everyone is okay with this? But the gross return is 1,000%. Isn't it right? That's the growth return. Your $100 grew to $1,000. So that's, you say, oh, that's tenfold in gross, tenfold in gross measure. In net return, ninefold, right? If your stock grew from $100 to $1,000, that's ninefold growth in net growth. Isn't that right? Net growth. But a tenfold growth in gross measure. right? In this case, so this is an extreme example, unrealistic. In reality, it would be more like this. Your stock was $90 last year, and this year, $100, right? Then you might say, oh, the return is 10%. No, the return is 11%, actually. Think about it, right? PT minus 1, which is, $10 over $90, it's 11%, 11.11, right? 11.11. 11.1111, 11.1111. Okay, that's the net return. Gross return, 111% because it includes itself, right? So net return of 11%. So this is the growth between, this is the growth between 0 and 1, right? This is the growth rate or return is a number between 0 and 1. I mean, most of the returns, most of the growth rates are something like this: 11%, 10%, 20%, 25%. It could be 50%, or it could be sometimes even 100%, but not too many stocks grow by 100% or 200%, right? Generally, that type of growth is very rare. Generally, they grow by 50%, 25%, 10%. The range of growth is just, somewhere between 0 and 1. Okay, it's somewhere between 0 and 1. But then that's the discrete growth. Let's take the log of these numbers. If I take log of and common log, right, to base 10. So log to base 10, right? Log to base 10 of 1,000, of course, it will be 3 because it's 10 to the third power, 3, right? And log of 100 to base 10, it will be 2, right? Everyone is okay with that. And then if I take the log of the gross return, right, it will be 1 because, obvious, right? 1,000 over 100 will be just 1. Also, because it is 10, right? Right, 1,000% is 10, tenfold, right? And base 10 log of 10 is 1, right? Now, in percentage, right? 1,000%, right? What this is, if you take the log of PT over PT minus 1, it will be 1,000 because it's 10, 1,000%, right? Just like this. In other words, if you do this, it should be 1,000%, right? In percentage, right? But what you see, what I did here, what did I do here? 10 raised to 3 minus 2. And what is that? What is that actually, that's basically, doing this, right? In other words, so let me take you back to the properties of log. So one of the properties of log is, if we have, log of a number, which is a product of log of this number, which is a product of like, other numbers. If log of x times y, if you have log of x times y, we can break it into log of x plus log of y. Okay, so 243 is like 9 times 27, which is log of 9 and log of 27. And if we are using the log to base 3, this is 3 squared, 3 cubed. So by this rule, right, by this rule, you move this down. This is going to become 2 times log 3 to 3, which is, right, which is 1, right, plus 3 times log of 3 to base 3, which gets, which is 1. So eventually it's 2 plus 3, which is, 5. But remember, this always, log is a way of representing a large number by the exponent of the base number. So that means 243 is the 5th power of 3, right? 243 is 5th power of 3, or the 5th root or 5th radical of 243 is 3. Okay, you understand what I'm saying? In other words, if you take the raised to 1 over 5. In other words, fifth radical, 1 over 5, 5th root of 243 is 3. Or on the other hand, 3 times, not 3 times, but what did I? On the other hand, 3 raised to 5 to 43, right? Or the 5th radical of 243 is, 3. So that's what one of the properties of log. Another property is, when we have, so it's a quotient rule. This is the product rule. Log of x of y can be written as log of x minus log of y. So something like log of 16 to base 2. 16 is what? Log of, log to base 2 of 64 over 4. 60, and because 64 is, log of 64 is 2 to the 6th power, 2 to the 6th power, and 4 is 2 to the 4th power, right? So 6 minus 2, 4. That's 2 to the 4th power. 2 to the 4th power is 16, right? So we can, rearrange we can use these, rules of log, right, to achieve our goal. We use it in our context. In other words, we have to utilize it in our context. So I just hate to write it like, but this time let's try this. This time, take the natural log. Previously, that was log to base 10, right? That was log to base 10. This time, natural log. So if you take the natural log of 1,000, that's the natural log value. If you take the natural log of 100, right, that's the natural log of 100. And if you take the, you see, the return, right? If you take the return, which will be, if you take the return, it's going to be log, the gross return, right? It will come to 2.3, will come to this. But you remember the quotient rule? You remember the quotient rule? Huh? What's the quotient rule? This log of x over y can be rewritten as log of x minus log of y. You can do the same thing here. I mean, it's not, what was, okay. You do, this is the same thing as this. You get the same result. It's the same result, right? And it will give you, and so if you turn it into, if you return it back to, if you return it back to the original number, which is 100, right? Remember, natural log of e, right, is 1, right? In other words, that's natural log of 2.718218, something like that. Right? If you remember this. So so if you take, if you take, and then also think about it. If you raise, I mean, if you take, if you raise e to 2.718, it will be 1, right? The same idea. If you raise, this number, I mean, if you raise, e to this number, it's going to be 10, which is exactly, 10 times, tenfold, which is 1,000, right? E raised to this number, it will be this. And for example, you have e here, right? So let's try this. E raised to oh, something's not right. Maybe I wasn't. That wasn't. So what I was trying to say is, if you take natural log of 2.718, it will be 1. Okay, and then if you take natural log of 1, you will get, if you take natural log of 1, you will get 2.718. So let's see. Take natural log of, okay, and take the natural log of that, of course, should be 1, right? If you take the natural log of Euler's number, it should be 1. And what else was I trying to do? But anyway, so here, this is basically a gross return, which is 1,000%. But obviously, we know the gross return is not the same thing as net return. The gross return is not the same thing as net return, right? And what this is doing is, gross return. But in this example, as you can see, the return is the return is not the number between 0 and 1. In this case, the return is way greater than 1, right? Return is greater than 1. So the gross return and the net return, when we take the natural log or continuous compounding, can't be the same. But if the return is, see here, if the return is here, a small number, small change, return is a small change, from $90 to $100, it's 11%. Don't 11.11%. Don't get misled. You think if it's 10%, 10%. If it grew to $99, if the price at time t is $99, then it will be 10%. Isn't that right? If the price grew from $90 to $99, then the return is 10%, right? But if it grew, by $10, then from $90, right? Then it is 11.11. And when there is a small change like that, 10% is not a small change, but still, it's somewhere between the return is between 0 and 1. For such a number, let's do the same thing for all over again. Log of PT is 2, of course. 100 is 10 squared. Log of PT minus 1, right? Common log of that, 1.954. And gross return, 0.046, right? A log of the gross return is, and if we raise it, if we find if you raise it to 10, right? What should I say? If you raise it by these changes to base 10, common law, right? It's 111%. Of course, in other words, what did I do here? Basically, I did, what I did here is, take the ratio between the two. PT over, in other words, PT over log of PT over log of PT minus 1, right? The gross return, right, it will be this. And also log of PT, of course, the log of PT, normally log of PT over log of PT minus 1 is not exactly it's not exactly the same thing as log of PT over PT minus 1, but in this case, it's the same. If I took the ratio, and the ratio is basically, uh, 100 is 10 squared, and to the base 10, this is 1.945. I mean, that's the exponent of 90. What 90 would be to 10. The exponent. What exponent? That's the exponent. What the exponent of 9, what should I say? That's the exponent of 90 to the base of 10. And if I take the ratio between the two, which is the difference between the two, because they all is 111%, which is the gross return. And if I do it even this way, the same thing, right? And think about it, this 0.046 is basically the difference between the two, right? It's the difference between the two. Now, let's take the natural log of this example. Natural log of 100 is 4.61. Natural log of 90 is this. If I take the natural log of PT over PT minus 1, right? It's 0.11. 0.11. So it's the net return. Of course, the gross return is 1.11. That's the gross return. But the net return, right? This gives the net return. And the net return is not, and you understand, this is the formula for gross return, but the gross return formula gives the same thing as the net return. You understand? The gross return gives you the same thing as the net return. Why? For a small change between 0 and 1, the natural log of the gross return is no different from the net return. And I'm getting tongue-tied. This is these are the there's no language. I mean, there's no easy language other than math. And to explain math into a verbal language, I mean, the world, the universe of math, to verbalize it, it's very difficult. I mean, it's not easy to smoothly. The only thing I can use is the analogy. The closest analogy is not even enough. But But anyway, the idea is this is why we use natural log for continuous time. Okay, this is why we use natural log for continuous return, continuously compounded return. This is why we use natural log. Okay, so of course, gross return is 111%. Gross return is 111%, but net return is 11%, which is given by natural log. Okay, so we can use, that's why, now the whole 2 hours have been dedicated just to explaining what? Just to explaining this. Why the whole 2 hours, entire 2 hours have been dedicated to explaining why continuous continuously compound return, why it is like this, why it is natural log of 1 plus EAR. And if you solve it backwards, right? Okay, of course, if you solve it backwards, then you will find EAR, which is this. So EAR, effective annual rate or effective interest rate. Sometimes also they call it AER, annual effective rate, well, whatever, or APY, right? APY. Okay, and think about it. So that's why this is why we need natural log, because we have to use continuously compounded rate, because in reality the time is continuous, and the things in the everything in the natural universe grows by continuous time. It doesn't, think about it, your growth since you were a baby, your height, your growth was continuous. It wasn't like sometimes they say, oh, you shot up an inch, you shot up 2 inches in just a year. Especially when you're a teenager, when your growth is very fast, when you are growing at a very high rate, your relatives see you in a year. I mean, they haven't seen you for years, and then they saw you particularly. Wow, I saw you last year, and last year when I saw you, you were just this tall. Now you're this tall. You shot up 2 inches in a year. What does that mean? Did you just December 31st last year, you were 5 foot 2 inches. December 31st this year, you are 5 foot 4 inches. Did this happen just at the strike of the clock on December 31st this year? You just shot up 2 inches at the end of this year? Obviously not. You all know that's not the case. What happened was you continuously grew, right? Over the course of the last year or this year, you continuously grew. And this growth, and everything, stock prices like that, there's no constant fluctuation in stock price. So the growth is continuous. It could be negative, positive, negative, positive, negative, positive, but it grows continuously. Therefore, we have to use, to capture the actual fluidity or actual smooth curvature, right? To capture that actual smooth curvature, we have to use continuous compounding. Okay, so it's already another again 11:35. So we'll take a break and come back 11:45. Okay, come back at 11:45. All right, we're back. We're back. So, oh, so let's go to scenario analysis, right? So now we know why we have to use the continuously compounded return, right? Then we need to apply that to scenario analysis. And scenario analysis is literally we give certain, we assume uh, certain scenarios over the course of in the economy over the course of the year, or the given holding period, right? So let's say if our holding period of our portfolio is 1 year, next year, coming year from now. But what scenario means? What's going to be the state of the economy? How is the state? Is it going to be, for the next year or for the next holding period? Will the economy be a boom or good economy, or normal economy, or recession, or I mean, we can think of several scenarios, like it could be a boom, or normal growth, or mild recession, or severe recession. But for the next year, what are the probabilities? What are the probabilities of those economic states to happen? So the probabilities are, of course, this probability is generally, in most cases, generated by something called, Monte Carlo studies. Okay, Monte Carlo experiment, and the Monte Carlo experiment study is that term is derived from, really, Monte Carlo, uh, the famous, resort town in French Riviera, where, but where what's Monte Carlo like? It's like Las Vegas or Atlantic City, and in Monte Carlo, a lot of gambling, right? So basically, gambling is basically a game of chance, isn't it right? Probability game of chance. So a lot of probability studies were done around, gambling. So that's why, Monte Carlo studies. So let's say the probabilities were, through the Monte Carlo studies, they found the result was that the probability of severe recession was 5%, mild recession is 25%, normal growth 40%, normal economy, boom 30%. If there are these probabilities, how is the economy going to turn out? I mean, how's our outcome going to turn out? In other words, from these possible 4 scenarios, our return will depend on these scenarios, and our returns under severe recession, our holding period return will be negative 37%. Under mild recession, negative 11%. On the normal growth, 14%. On the boom, 30%. And then what we need to do is we need to find the weighted average of these, right? Weighted average, because weighted average is basically the result of weighting these probabilities to these possible potential outcomes. So weighted average is the likeliest outcome that can come out of this these scenarios, right? So because we have 4 different states in the scenario, we don't know what it's going to be for the next year or for our holding period. But one thing we can be sure of is that the outcome or the return, right, will follow pretty much the weighted average of all these possible states. And then, if we find the weighted average, right? And so the weighted average is, let's say, that's the expected return. And if the expected return comes to 10%, there will be a variance around it. In other words, the potential, what would be the deviation from this expected return? So it's basically mean and standard deviation concept. So which is not a difficult thing. So let's do this. So the same file, chapter 5 and 6 exercises, right? You already, if you did this, right? You have that file already down there. Click this bottom tab, right? SS5, whatever, SS5.1, figure 5.2. Okay, everyone is there? You're dead quiet, so I don't know if you are, if you heard me. I don't know if anyone is really there at all. All righty, so are you guys there? Charles, are you there? Charles?
Yes, we're here, Professor.
Irina, I know you are there. I asked Charles. Is Charles there? Damien, are you there? Damien, are you there?
Yeah, I'm also here.
Okay, Damien. And
Yeah, I'm here, Professor.
Neutral.
I'm here, Professor.
Ebony, yeah, I got you. I see your microphone. Ebony, are you there? Ebony? Ebony is away, obviously. Karimov, are you there, Karimov? Piotr, are you there, Piotr?
I'm here, Professor.
Okay. All right, there's a lot of echo. Robert, are you there, Robert? Apparently Robert is away. Shabir, are you there, Shabir? Robert, delayed response. -5 points for delayed response. Okay. Shabir, of course, I'm, yeah, Shabir, Robert, I'm okay. All right, but I was just joking, I won't take 5 points off for delayed response. Really. Shabir, are you there, Shabir? Was Shabir there? Robert. Okay, Shabir is there. Okay. All righty. So you guys are all on this page. Are you guys all on this page?
Yes, Professor.
All right, thank you, Irina. I'll give you 0.5 for being very responsive, right? Irina, I'll give you.
Thank you.
0.5. You're welcome. I mean, I should, of course, it's only fitting and proper to reward a student that is very responsive and active. And the students who are almost dead, I mean, I cannot even give you a point because you're dead, right? You're dead quiet. I don't know if you're really dead or alive, so I can't even give you a point. Now, this one, this is something you already know. We'll do this later, but let's do this first. So basically, how do we find the expected return, and how do we find, variance and standard deviation? This is something we also did in the Finance 100, but in a slightly different context. Now, So what would be the weighted return in under severe recession, under the severe recession scenario? Well, we weight the probability, right, to the we weight it to the holding period return, and it's going to be like this. You just drag it down. It's going to be like this, and you sum all of those, right? Then that comes to 10%. Okay. Now, next, although the mean return or the expected return is 10%, but there are these possible scenarios. So if these possible scenarios happen, I mean, these will be the returns. So what will be the deviation? What will be the deviation from the expected return, from the mean return? Well, so we do basically this minus this. That will be the deviation. And you're going to need to lock it by hitting F4, right? For some people, function key F4, right? F4 is, function key. So you will need, if you have Apple computer, you will have to press function key as well. But if you have, IBM variety, IBM variant, if you have IBM variant PC, right, you can just hit F4. And you lock it because you want to drag it down. I'm going to drag it down like this. Okay, I drag it down. So these are the deviations, right? Deviations from the mean. And the whole point is, I want to know what is the average deviation from the mean, from the expected return. So to do that, I will have to sum everything divided by number of scenarios, which are 4. But if you do that, you will see it's going to be 0. Right? Why? Because all these deviations what did I do? I'm sorry. What I did was not this one. This one, this one. I almost, made a, right? Because these are the returns under the scenario before getting weighted. Now think about it. If you do this, if you just, add them up and divide it by 4, it will be 0. It will be 0, right? It's going to be 0. And you might, why? No, I don't think it is 0, but, believe you me, it will be, if I do it, let's try that. Sum all of those. Because there are 4 data points, count 4 data points. Oh, it's not 0 actually. Because this is not randomly distributed. But anyway, but that is not doing the justice. That's not doing the justice. If it is a random sample, and if we have at least a set of sufficiently large data set, like at least with 30 data points or more, it will be 0. But not, because it is random. This is not random, so that's why. So as I said, what we want to know is what's going to be the average deviation. But to find the average deviation, you cannot simply take the average of this. What you need to do is you'll need to, if it is a random sample, and a large enough sample, then the average deviation will come to 0. And so to prevent that, we will need to use squared terms, because the reason in a large enough data set, the reason why the average comes to 0 is because some of those negatives will cancel out with positives, right? But this is not a large enough sample, and this is not a random sample, so it doesn't cancel out. But large enough random sample is going to cancel out. So in that case, so that's why, to avoid that, we will have to take the squared term of those differences, because the squared term of those differences will, because everything is positive. Everything squared is positive. Negative term squared is positive. So that way we can work with without losing any data point, right? In a large enough sample. If there are 60 data points, we'll still have 60 data points without losing any data point. And then we can find average deviation by using that data set. But here, so what I want to do is, first I will square it, so everything will be positive, right? Okay, and next I will, because there's a probability, right? Just like probability, weighted return. This is called the squared difference term, SSQ. These squared difference terms must be also weighted as well. So I'm gonna weight it by these probabilities. Okay, and then I drag it down, and everything is weighted. Now, when you find the sum, when you take the sum of those weighted, probability weighted difference terms, squared difference terms, right? So this is like, times squared difference terms. Right? Squared difference terms. This is just the difference term. And sum of all those probability weighted square difference term is the variance. Okay, and so variance is like the average deviation from the mean, right? Average deviation from the mean, but that's not the life-size picture. It's the blown-up picture, right? If this is the picture, this is a blown-up picture, not the life-size picture of the average deviation from the mean, right? From the expected return, but it's a blown-up because it's squared. It's blown up, right? It's blown up, but we know how to revert it back to life-size picture, right? Why? Because this is a blown up picture because it's squared. So if you turn it back to life-size picture, what do you need to do? You need to take the square root of the blown up picture. if you take the square root of the blown up picture, it will become a life-size picture, right? So then I take the square root. Square root, you can take the square root this way, square root of this. There you go. Or you can either do it that way, or you can also do it, this way. Square root is, half power, right? Same thing. F12 over square root of that. Why is it? Something's not right. F11. Oh, what is F? Oh, it should be F12. Why is it F11? F12. I'm sorry, F12. So this is the life-size picture of the average deviation from the mean. Okay. Now, some people might wonder, this is the if this is the blown up picture, how come the blown up picture is smaller than the life-size picture? Look, it's only an analogy, right? Life-size picture, blown up picture is only an analogy. But think about it. This is a number between 0 and 1. I mean, if when you square 0.2, if you square 0.2, if you any number that's between 0 and 1, any number that's smaller than 1 but greater than 0, if you square it, will it be bigger than its original self? Well, elementary school kids won't understand this, but at least a middle school kid would understand this. Yeah, a number between 0 and 1, when it is squared, it will become smaller. When it is, cubed, it will become much smaller. Of course, 0.2, if you square it, it's 0.04. 0.5 squared, 0.25. It gets smaller, right? A number between 0 and 1, when squared, it gets smaller. So it makes sense. It only makes sense, right? If the square root of this number, it's a number, it's like 0.0347, right? 3.4% is 0.0347. So a square root of that would have to be a bigger number, right? And when you square this 18.6 or 0.1863, if you square it, it will have to be much smaller number. Okay, so the life-size picture of the average deviation from the mean is 18.63. Okay, everyone is okay with that? And how does that how is it going to play in our scenario? Well, it's all about normal distribution. Now, because we will need to borrow the properties of normal distribution. And of course, normal distribution, we talked about this also we discussed this in Finance 100. But again, let's see. So here, yeah. This is basically the properties of normal distribution, right? if the mean is 10%, right? This mean is 10%, and the standard deviation is 30%. What is if the standard deviation is 20%, right? You can tell from this that the standard deviation is 20%. Now, one standard deviation above the mean is 30%. Two standard deviations above the mean is 50%. One standard deviation below mean is negative 10%. Another standard deviation away from the mean, so two standard deviations below mean is negative 30%, right? So if our portfolio, I mean, in our portfolio, right, in our example, the standard deviation was 18.63, but let's approximate it as 20%. If you approximate it as 20%, yeah, it's about like this. So what a normal distribution tells you is that about 96%, so this is almost 96%, right? There's a 96% chance that the actual returns will fall within two standard deviations around the mean, right? 96% chance, right? The actual return, holding period return. So it could, that means, you can have like 49% return, or you can have 30% return, you can have 50% return, right? But any return between negative 30% and positive 50%, I mean, the range of probability of those returns happening is 96%. Okay, so it's a quite broad range. Now, also according to the normal distribution properties, right? You have 68% probability of actual returns happening between one standard deviation around the mean, right? Which means, the probabilities of getting any return between 10% and 30%, or between, negative 10% and 30%, there's a, 68% probability of getting, some return between negative 10% and positive 30%. Okay? That also means that there is a 34%, probability of getting any actual return from our portfolio being somewhere between 10 and 30%. Also, there is, a 34% probability that the actual return on our portfolio will be somewhere between 10% and negative 10%. Okay. Also, that means there is a think about it, because probability for returns within two standard deviation is 96%. What's the difference between 96% and 68%. 28%, isn't that right? 28. So that means 14% of that 28% lies in this range between 1 standard deviation and 2 standard deviation. And there is another 14% probability lying within -1 standard deviation and -2 standard deviation. So that is in percentage. Yeah, the probability of your portfolio earning anywhere between 30% and 50%, the probability of those returns is 14%. And the probability of earning anywhere between -10% and -30% is also 14%. Right? And then think about it. So between outside 2 standard deviation area, so within 2 standard deviation is like 96%. So outside 2 standard deviation it's like 4%. So it's 2% in the right tail, 2% in the left tail. That those 2% are probabilities of you earning extreme returns, such as even above 50%, like 70, even 90%. Everything outside 2 standard deviation, that area, everything outside that 2 standard deviation area has the probability of 2%. So those are called outliers. These are outliers. Isn't that right? Think about it. Average height is let's say 5'10", 5'10", and standard deviation is 2 inches. That means what? What is the probability of running into someone who is between 5'10" and 6 foot? The probability is 34%. What is the probability of running into someone who is between 5'10" and 5'8"? Another 34%. What's the probability of running into someone who is between 6 foot and 6'2"? 14%. What's the probability of running into you just walk into the street like 40 Times Square, and there you run into random people, and out of those random people, what's the probability of into someone who is between 5'8" and 5'6"? 14%. What's the and if that's the case, what's the probability of running into someone who is above 6'2"? 2%. And if that means 2% of the population is above 6'2", maybe 6'4" would be more like it. But that someone is certainly an outlier. And what's the probability of running into someone who is below 5'6"? 2%. So someone who is below 5'4" is also an outlier, right? That's what. So with this normal distribution properties, we can make a prediction more specifically about what is going to be, what are the chances of our portfolio earning like 35% return, right? But another thing is something we called likewise normal distribution. In other words, so our portfolio scenario is what? This is our portfolio scenario. under severe recession, mild recession, normal growth, boom, these are the returns that can, and so the expected return from our portfolio is 10%, and our standard deviation is 18. But is this so? Does our scenario have a normal distribution? I mean, the distribution from our scenario, does it conform to the normal distribution? I mean, we may not be talking about, our scenario may not be displaying normal distribution properties. I mean, if it is displaying normal distribution properties, you should, what is this? If it is displaying normal distribution properties, then the results should show, the result must show something like this, right? Something like, where am I? What was that? The result must show a symmetrical distribution like this. But our scenario may not display a scenario like that. Rather, it might display a scenario like this, or a scenario like this. Okay? Or even if it is the same mean, the scenario could be more like same our scenario may look more like this. It could be more like this. Our scenario may be more like this. So in other words, nothing guarantees that our scenario would exhibit perfectly normal distribution properties. Our scenario may be, so we need to check if our scenario is like this or if it is not like this. Okay, so that's something we will discuss next time. Okay, we're already like 10 minutes past our official time, so I will have to call it a day here. So any questions so far? Any questions? Any questions so far?
No,
Anyone
Professor.
there? Okay, so all right. Dimitri, okay, good. I can see you are there, but I believe not a lot of people are here. But look, you're not doing this for anybody else. You're doing this for your own sake. So the time that you are not, if you are not paying attention to this class, you're not making, you're not making a good use of time. You are actually, wasting your time, right? And that's, basically you're doing a disservice to yourself, right? Because you're doing this for yourself, for your own sake, not for anybody else. Okay. All righty. So I will see you guys next Saturday. But please remember, I believe I already made that announcement. Quiz midterm three, right? This one went out yesterday already. So midterm 3 will start next Friday. So please, please take note of that. Okay. Alrighty. So I will see you guys next Saturday. Have a great afternoon and great weekend. Stop recording.